Okay, good afternoon, everybody. This is Jim Kenny here, and I'll be moderating the broadcast here today. Today, we're going to go over, as you can see, understanding professionally managed futures. By way of introduction, I would like to introduce myself. Again, I'm Jim Kenny, branch manager for High Ridge Futures. HRF is an introducing broker, and HRF has a clearing relationship with ADM Investor Services. Now, I'll discuss that further detail a little later in the webinar, but a quick background on myself. I'm a graduate of Boston College, and I've been registered with the NFA for over 30 years. I passed my examination during my career, a number of them, including Series 3 for futures and also Series 30 for branch manager. I believe I'm qualified to explain the uses and the risks of diversifying with managed futures to qualified, suitable investors, and I'll begin that process right now. Now, before we get started, there'll be a slideshow coming up here, and there'll be some references using indexes to manage futures and the stock market. With the stock market, there'll be indexes such as the S&P 500 index and the Dow Jones. And with the CTA index, they'll use things such as Autumn Gold and the Barclay Top 50. Now, there are limitations to the value of these comparisons because obviously they're not specific to one advisor or one stock, and it might not be your advisor or your stock that's being represented. So remember, it is for illustrative purposes only. In addition to that, it is going to be based on historical information, and therefore remember that past performance is not necessarily indicative of future results. Now, before we get started, each and every broadcast, we do bring up the risk disclosure statement from the CFTC, which I'm going to do right now. There you go. Okay, obviously this cannot be an exhaustive disclosure of risk on everything you need to know or want to know before you invest in this medium, but it is a start, and it is something we start out with. Now, some of the highlights of the disclosure statement, which you can read right in front of you, would include that that trading of this type is not suitable for all investors. And another area that's covered is that there is a risk of loss which can be substantial no matter who's managing your money, and that, of course, past performance is not necessarily indicative of future results, okay? I'll be getting into that more in detail because some of the things we'll be talking about later will be individual advisors that I've zeroed in on and some of their historical records, which, again, past performance, not necessarily indicative of the future results. Also, you'll be made available to you disclosure documents, which are much more comprehensive as to the methodology, the risks, the fees, the incentives, and the backgrounds of each advisor. So obviously, we encourage you and actually will provide that information to you after the broadcast if you have an interest in this area. Okay. All right. Moving right along, I am going to go over some thought-provoking questions here. And the thought-provoking questions that I have here will be backed up by illustrative examples, as I was mentioning, comparative studies, and they'll be coming up forthcoming. But just to give you an idea, some of the questions we'll be addressing. One will be that during the 5 worst period declines in stocks since 1987, how did the managed futures indexes stack up? Also, during the last 15 worst quarters for stocks over the last 25 years, how did managed futures compare? Then, of course, critical events over the last 35 years, managed futures, how did they work out? And on the indexes. And then, of course, the very worst stock market declines in history since 87. And how have the managed futures worked with the indexes during those periods? Now, I will be getting into that momentarily, but the first thing I like to bring up is the amount of assets that have come into the, total assets coming into managed futures since 2000 about, okay, about 16 years. It's been an increase of 796%. So the cash flow coming into this has been very, very significant. That doesn't mean it's right for you, but it's just showing that there is interest in this asset class, and it might be of interest to you as you look into it further. Okay, this was according to the Barclay Hedge, one of the oldest, most respected providers of alternative investment data. So that's who provided the information. All right. Now, again, before we get into talking about how much money has come into this asset class, let's explain what it is all about in the first place. First of all, what is managed futures? That's where a managed futures account is where a registered commodity trading advisor, or CTA, is given a responsibility to do all the trading. Okay, and this authority is delegated to the by the account holder to the CTA by a limited power of attorney, which can be withdrawn at any time. Now, CTAs are registered with the CFTC. That's an agency of the federal government, and they're members of the NFA, the National Futures Association, which is a self-regulatory body authorized by Congress back in '82. Now, these guys are professional money managers, and they work with investor assets in a way similar to a stock mutual fund manager would invest, only they're using commodities and futures contracts and options or whatever they're using versus stock or stock options. Okay, you can use the managed futures in a number of different accounts, including qualified retirement plans, IRAs, trust, and pension plans for suitable and qualified people. Okay, so that's a little bit of what we're talking about. Okay, moving to the next slide, you can see there's a chart on the growth of the industry right there in front of you. You can see that, since 2000, it has really moved up, and it's 796% increase over that period of time. So there certainly has been quite a bit of money come into this space. Let's go to another quantitative analysis here. In 1980, there was about $1 billion in managed futures. In 2000, there was 37.9 billion. And at the end of the fourth quarter of last year, we're up to 339 and change. That's almost 340 billion in managed futures. So that puts the amount of money in perspective and clearly shows you that there has been money flow coming into this asset class. Again, doesn't mean it's right for you, but it would be something to maybe investigate. Okay, so now we go to the slides. And with the top 50 for the Barclays, which is an index of many different advisors. Okay, and so it's not going to be specific to one person. As you can see from the graph, comparing the S&P's 5 worst drawdowns since '87, the comparative between the two indexes, Barclay Top 50, and here we're talking about the S&P 500, which was a study that was put together also. It supports the study from the late Harvard professor, Dr. John Littner, who did conclude that by putting managed futures into a portfolio, you can change the dynamic of performance and risk. And that is why some people like to diversify into these type of things. Okay, next thing here. Performance of the Barclay Top 50 Index during the 15 worst quarters. There you go. All the bad times right in front of you there. You got fourth quarter of 1987. You've got fourth quarter of 08, 2002. Those horrific terrorist attacks, Iraq attack, Kuwait. And then you've got the aftermath of the tech bubble, another tech problem in 01. The European sovereign debt, credit crisis, defaults, a lot of debt problems, another credit crisis. It looks like a lot of credit crises when you look at it there, huh? So at any rate, there is the differential between the performance of the S&P 500 Total Return Index and the Barclay Top 50. And the differential there is cited, and it's all documented. So that's a quantitative comparison that is favorable for the index of managed futures versus the stock index. Next one here is going to be CTA return during periods when the S&P lost more than 10%. And here you've got the comparative study. And again, it's a favorable comparison when you're taking the autumn gold CTA index. And that reflects the average performance of the CTAs reporting to autumn gold. So this is a limited universe, therefore it has limited value. Next one here is returns during critical events, 84 to 2016, nasty times again, Persian Gulf, 9/11, subprime, U.S. debt downgraded to AA, and there you go. So the comparative study, again, the blue is managed futures, the red is U.S. stocks, and you can see the study's pretty attractive for one over the other. Okay, let's go down here to managed futures performance during the stock market declines, worst ones. There they are right there, big stock market drops, and then you got the Barclay Top Index actually doing quite a bit better. Here you go, allocating 20% with the managed futures. As you can see, the theory is the indexes show that there can be an effect, a material effect on the risk when you do diversify. The concept here, although it's not assured to occur by any means, the concept here is that because they're not into stocks per se like the ones you own, not into bonds per se like the ones you own, it's a separate asset class. Ergo, it should change the dynamic of risk and performance. That's the concept, that's the theory, that's the objective, but of course, no assurance that'll all go down. Okay. Next one is the performance results for a 37 study comparing managed futures to U.S. stocks and the international stock. And the internationals, you can see, been lagging for a long time behind the U.S. and the managed futures. And probably a number of reasons for that. But you can see, there you go, the managed futures index here, and compared favorably in this context. And there you go about the enhancement. Again, when you're putting in managed futures into a portfolio, you obviously are changing the dynamic. And when you change the dynamic, it should have an effect on a risk and performance. And the concept is to try to reduce the risk and enhance the performance. That's the objective, that's the goal, that's the theory. No assurance that that will occur. But that's why people are diversifying, because they're trying to spread it around a little bit. Okay. Next one here is amateurs versus professionals, and here's where I would like to get into some of the guys that I've zeroed in on. Now, again, a lot of people who have the tempo and the time and everything else, they can trade everything on their own, from their stocks to their bonds to their futures to their options, you name it, they can do it because they just have it all. And there are those who do not, and then they want to seek out a professional who might be able to help them with it. And that's where these guys might come in. So the HRF has got on their website a number of CTAs that they've done due diligence on. I've zeroed in on 3, and I'd like to explain who they are. First one is called the White River Group. They've got 2 programs. First one is called the Stock Index Option Writing Strategy. Now, this one's been around for a while. It started in November of 2008. So it's been around for a good long period of time. I've got a tear sheet here that's available to each and every one of you who are interested. And just to pick off some of the information, I don't have time to go through the whole tear sheet. That's why it's available to you in its entirety. But since the inception, the total return has been just a shade under 160% at 159.18 through the first quarter of this year. Now, the compounded annual return, just a shade under 12 at 11.98. And here's the kicker on some people's interest, is the amount of winning months versus losing months. And the amount of winning months here, there's been 101 months, right? And 82 of them been profitable, only 19 non-profitable. And what I like about this guy, as far as his compensation, part of his compensation is linked to your account growing. The growing of the account, he's got a vested interest because he gets a percentage of profit, and it has to be net new profits. So if there's any setbacks, that incentive is suspended until he makes up the drawdown. So that, in my view, my opinion, is a good check and balance, and it keeps the advisor very keen on trying to keep the equity moving forward. The second program that this gentleman has, and his name is Andreas Diesbacher, is called the Dynamic. And the Dynamic program, it's called the Dynamic S&P Option Strategy, has been around since November of 2014. So it hasn't been around as long as the original, but it's done a pretty good job on the time it's been around. Since November 2014, the cumulative return since inception is over 32%. That's through the first quarter of this year. And then the profitable months versus non-profitable is pretty astounding. Out of the 29 months that it's been around through the first quarter, 28 months have been profitable. Again, this gentleman gets paid a percentage of profit as part of his compensation. He has a vested interest in these accounts growing. Now, I just cited off some historical information. Want to make sure we're clear. Past performance, not necessarily indicative of future results. And so you cannot be expecting the results to be exactly the same because the world is an unknown looking forward. So bear that in mind. But that's what has been done. And some people like to see a little bit of history before they look at anything further. The next gentleman who I've zeroed in on is called Pacific Front Capital. And this gentleman differs from White River in a number of senses, including the length of which he's been trading. Last year was the first year for Pacific Front, and their cumulative return for the year was 128.45%. That was quite a first year. And then the worst drawdown, for the month was 9.58%, and the average monthly return was 10.28%. So this obviously is an advisor who had a very good first year out of the chute. And basically, for people who are looking for a more aggressive advisor, this might be someone to take a look at, a hard look at. This is called Pacific Front Capital. He as well is paid as in part, compensated with a percentage of profit. Again, vested interest in the accounts growing. And if there's a drawdown, no incentive until the loss is made up. Now, again, past performance, not necessarily indicative of results, but the last year's results certainly were attractive to investors who did participate. Finally, we do have a advisor for qualified eligible persons. They call them QEPs. You need to have certain criterion, including income and net worth. And so I cannot talk about it any further. But if you are a qualified eligible person, and some of you are, and some of you are not, I'd be more than happy after you sign off attesting to that, the information that would be for you on this particular advisor, because I find this advisor to be very attractive. Their methodology and their historical performance. Again, past performance, not necessarily indicative of future results, but something that might be worthwhile to look into for the qualified eligible persons. I can get into that after the broadcast or tomorrow during business hours. Now, this type of diversification is not right for everybody. So after investigating the disclosure documents and all the features and all the benefits and all the risks associated to it and costs and everything else, expenses, if you find out you want to proceed with part of your capital and you find that you're a qualified person and you're suitable for this type of thing, then you'd probably want to know how it works. Okay, so say you decide to move forward. Now, before we talk about moving forward, though, and how that works, I'd like to get into treatment. Okay, are there any tax benefits to this type of asset class trading? And the answer is yes. According to the tax 19 term profits in commodities are treating 60% long-term, 40% short. On the other hand, short-term trading profits in stocks are treated 100% short-term. Now, short-term investment is one that's held less than a year. This favorable tax treatment translates to investors in the upper brackets of savings of up as much as 30%. So some of you guys out there in the higher brackets might find this very interesting. And again, we say all the time, consult your tax advisor or professional, your specific tax picture before you proceed or do anything with this. But for some of you, after investigation by your tax guys, you might find out that this is a pretty good kicker. And so keep an eye on that for you guys who are interested in the tax ramifications. Okay, so now you've decided to move forward, and let's say how that works, okay? Where's your money kept? Your money's kept in a segregated customer segregated account at ADM Investor Services. They've been around for over 50 years. How accessible are your funds? High degree of liquidity. We strongly advise people view it as a long-term investment, but at the end of the day, it's your money. You want out, you can do it. And your funds, part or all of them, are available at any time. Is the account, the money in the managed account safe? Well, like I said, it's in a segregated account. The CFTC do not allow the Futures Commission merchants, meaning ADM Investor Services, to commingle segregated funds. However, that is not going to absolve you from market risk. So your trading losses will still be there if there are, but as far as the actual cash, there has been, obviously, with the segregated account, steps taken to try to make that happen. Now, you got an account going. You want to know how to track it. Well, you know, a lot of you have accounts already. What do? First thing you do is you go online 24 hours a day, right? And what do you put in? Your username and your password. What do you find out? Bingo, where all your accounts are and where they settled and what's the value and this and that, right? So first thing is you're going to go online, do the same thing you did with all your other accounts. Second thing is you give us a call. You can ask us questions as well. And third thing is there's any activity, you got an activity generated confirmation. It'll go out to you. And at the end of the month, you get a monthly statement. A lot of transparency here because each person has their own positions. This is not a mutual fund or an ETF where you don't know what your positions are in your account. So you know them because they're specific to you. Okay? So a lot of transparency, a lot of access to the accounts, liquidity, and diversification. That's why people participate after they investigate. Okay, so I'm going to go back here and I'm going to repeat my name and phone number so that you can write it down. My name is Jim Kenney, K-E-N-N-E-Y, 2-873-5707. And you can call me after the broadcast. It gets busy, so if you get a busy, not a busy signal, but if you go to voicemail, it's because the lines are tied up. And otherwise, you can call tomorrow during market hours or afterwards if you'd like to wait a minute or two. And the phone number again, 702-873-5707. Okay? There's a lot to learn here. It's not right for everybody, but some of you might find this a very reasonable diversification with professional money management and the trading advisors having a vested interest in the growth of the account through part of their compensation being linked to a percentage of profit incentive. And of course, that is just one of many things that's covered in the disclosure document. Please, again, get the tear sheets by calling 702-873-5707. I'd like to thank you all for being here. It's always a pleasure to educate people and let them know that this is available and give them an opportunity to look into it further, to see exactly how it works and exactly if it could be right for part of your capital. All right? All right. Again, everybody, until we talk again or till you call me and we talk on the phone, I wish you all good luck and good trading. And until next time, the best of everything. Talk to you later. Good night, everybody.